So hello, everyone. Tim Eberle. I'm a managing director here at Citco, and I oversee Citco's waterfall function. So anything that has to do with carried interest calculations, capital distributions falls under my purview. You may be aware of Citco as a leading global fund administrator, but as a component of our administration offering, we also have a significant book of institutional limited partners, family office clients, and I work with those LPs in my capacity overseeing Citco's fee verification offering, which is essentially an offering where we'll recalculate management fees and carried interest that a limited partner or an allocator is subject to ensure that the carried interest that they're being charged is accurate and in line with a fund's governing documents. But so we're here today to talk about a specific aspect of the carried interest calculation, which is the calculation of clawback. And we're here to talk about that specifically because over the course of the last year, Citco's identified a really interesting trend. We've seen about a 35 to 40% uptick in general partners coming to Citco to assist with scenario modeling and scenario analytics to identify the risk of a clawback event within their funds. And the reason for that makes sense, right? We are in a macroeconomic environment where private equity realizations are slowing. The rate at which capital is being returned to limited partners is slowing. We attribute that to a couple of things, rising interest rates, the war in Ukraine, the trouble with the tech markets, but all of those events are leading to a slowing environment of realizations within the private equity space. And anytime you see that, anytime you see private equity funds delaying realizations and the associated distributions back to the limited partners, the risk of a clawback event increases almost exponentially. And let's talk about why that is, right? So just to make sure we're all using the same terms in the same way, when we say clawback, we're referring to an allocation of carried interest to the general partner, meaning carried interest that the limited partner has paid that when looked at on an inception to date basis exceeds the threshold that the limited partner should be paying, meaning on an inception to date basis, the LP has paid the GP something in excess of 20% of total profits as carried interest, depending on the waterfall structure. So generally speaking, you see clawback associated with American-style waterfalls. With a European-style waterfall, it's much more difficult to find yourself in a clawback situation, although that certainly happens. And again, just to make sure we're all using the same terms in the same way, a European-style waterfall refers to a calculation of carried interest wherein the limited partner must first recoup 100% of their capital contributions and an associated preferred return on those capital contributions before the GP is eligible for an allocation of carry. An American-style waterfall, or more sort of a pay-as-you-go waterfall, allows the GP to realize carried interest associated with any profitable investment realization without the associated burden of recouping 100% of capital contributions to the limited partner. So you contribute $1 million to the GP buys 10 $100,000 investments with that money. They sell one of those $100,000 investments. They're able to take carry on any profits associated with that realization without first returning back to you, the limited partner, the $900 in unrealized capital contributions. Now, let's say we get to the next event. We're selling the next $100,000 deal. We sell that deal at zero. If the GP had taken carry on that first realization, we're now in a clawback event because on an inception to date basis, the GP is taking something in excess of 20% of total profits as carried interest. So the first thought, and generally when we're talking to limited partners, their first thought is, okay, well, why don't I just insist on a European style waterfall, right? Again, it's very, very difficult to find yourself in a clawback situation if you're getting all of your capital and your pref back before the GP is eligible for an allocation of carried interest. But I always push back on that, right? Because ultimately, when you're investing in a money manager, you're investing in an investment manager, a general partner, much more so than you are investing in a particular capital structure. And rightly or wrongly, the large mega funds, your KKRs, your EQTs, your TPGs, your Apollos, the funds who don't have to fight so much for LP capital, have American-style waterfalls. Those waterfalls aren't going anywhere. If anything, those waterfall calculations are getting more and more complex. The benefit to those funds of having an American-style waterfall clearly is that they're able to keep and retain top investment talent. If you're able to pay your people by an American-style waterfall years in advance of where you would be able to with a European-style waterfall, that becomes very attractive to top investment professionals, which is one of the reasons why you see those large funds with such significant returns. So it's our contention that you can, as a limited partner, mitigate the risk of clawback without insisting on a European style waterfall structure, which is something that has traditionally been very, very difficult to do. I don't know if we have members of ILPA in the room. A couple of years ago, as I'm sure you're aware, ILPA came out with their standard waterfall, didn't really go anywhere, didn't gain wide adoption. The GPs or the GPs with performance, the GPs who can, are always going to insist on an American style waterfall. So when we're talking to limited partners, we want to talk today about ways that we can mitigate the risk of clawback within that waterfall style structure. And there are a couple broad ways that we can do that. The most important, at least in my opinion, are structural ways of mitigating clawback, meaning provisions that are codified into fund LPAs, either by a side letter or by working with the limited partners, the general partner, just to adopt a different style waterfall. The first and most significant piece of advice that we always have for limited partners is understand the deferred carry provisions within the limited partnership agreement that you are subject to. And when we say deferred carry means a distribution to the limited partners of dollars that otherwise would have gone to the LP as carried interest. It's not a segregated reserve concept. It's not an escrow concept. These are dollars that are actually distributed back to the limited partner. The vast majority of limited partnership agreements contain deferred carry provisions. Very rarely is the GP required to take all of the carry that they're eligible for. And so what we always recommend as a starting point is ensure that the deferred carry provisions in your LPA are very clear and very well understood. And so that at the time of a distribution, rather than just getting a check and getting a PCAP statement, you're able to work with your general partner to figure out what carry they are entitled to and then what carry is deferred, and working with them on making that decision. Is it carried interest that we're just taking on current income? Is that a little bit too early? What's our unrealized portfolio doing? Do we have to recoup write-downs? Are all of my investments held at cost? On that note, we also strongly recommend that at the time of a fund structuring and at the time documents are being written, that limited partners insist on a post-carry fair value test. Now, when we say a post-carry fair value test, this is a codified mechanism that forces the general partner to defer carried interest that they otherwise would be eligible for based on the unrealized performance of their portfolio. And it's generally a very simple calculation. So let's go back to that earlier example where we have 10 deals in a portfolio, we realize one. Before the GP is eligible to take carry on that interest, we need to run all of those 9 unrealized investments through a waterfall calculation as well. And so if those investments are underwater or if those investments are held at cost, that will calculate at the time of a realization how much of the carry that the GP is eligible for associated with that early realization would immediately be subject to clawback. Sort of market standard with post-carry fair value tests is a 2.5x. So if the unrealized value of your portfolio hasn't exceeded 2.5, right, if we're below that multiple, any carry that the GP would be eligible for is otherwise deferred back to the limited partners. That carry doesn't go away, right? Waterfall calculations, as I'm sure you know, or those of you who work in these things on a day-to-day basis, are inception to date concepts. So we're not saying that the GP is not going to get that carry. We're saying that the GP is not going to get that carry today. The GP also gets the benefit via these deferred carry provisions of returning a little bit of capital in advance of when they would have to otherwise, of stopping preferred return when they otherwise wouldn't be eligible for that. So post-carry fair value tests within an American-style waterfall are probably the most significant structural mechanism that we see to, if not eliminate, very significantly hedge against the risk of clawback. What we also recommend is that funds or limited partners, rather, that are subject to an American style waterfall insist upon what we call an aggregate expense recoupment provision. So within a deal by deal waterfall, without getting too into the weeds, we need a mechanism by which to determine how much capital that was used for non-investment activity to return to the limited partner at the time of a distribution. So tier one in American style waterfall, generally speaking, is a recoupment of capital to the limited partner of dollars used to fund investments that have been subject to a realization. I bought a bunch of deals. I sold a bunch of deals. Those deals that I've sold, the LP needs to be recouped their capital before we're able to take carried interest. But we have this other bucket of capital contributions used for non-investments activity. Pay management fees, pay operating expenses, pay legal fees, pay administration fees. At some point, those dollars need to get recouped to the limited partners as well. Now, in a traditional market standard American style waterfall, non-investment capital contributions, and let's just simplify it and say capital that was contributed to pay management fees and expenses, are returned to the limited partner in proportion to the investment's realization, meaning as we realize investments, a proportionate share of capital called for fees and expenses goes back to the limited partner. So again, using that overly simplified example, if we have 10 deals, we sell one, we realize 10% of the portfolio, we're going to return 10% of capital contributed to management fees and expenses to the limited partner and an associated preferred return on that. Very aggressive, right? What we recommend is what we call an aggregate expense recoupment provision. Now, in an aggregate expensement recoup provision within an American style waterfall, 100% of capital contributed for management fees and expenses are returned to the limited partner at the time of the distribution, which obviously is going to be a more significant number, right? Effectively, what we're doing within that provision is we're realizing capital called for fees and expenses at the time they're contributed. So as soon as you contribute money for a fee or an expense, you have to get 100% of those dollars back before the GP is able to take carry on their investment activity. Now, what that's doing is that's kind of front-loading capital distributions back to the limited partner. And anytime you do that, right, anytime you advance dollars back to the limited partner, almost by definition, you're hedging yourself against a clawback event because you're delaying carried interest to the general partner. We also recommend that limited partners explore, when they're talking about preferred return, a non-time weighted rate of return. So market standard today, and this has kind of been standard for the last, 10 years or so, is that preferred return is calculated as an annually compounding rate of return, an internal rate of return, an IRR. Generally speaking, that's 8%, although that's sort of starting to change as funds and limited partners get a little bit more creative. Now, what a time-weighted rate of return does, kind of by definition, is it puts time pressure on the general partner. An IRR calculation is an exponential equation, right? It's an annually compounding daily calculated rate of return that sort of goes up as a slope, meaning every day that we don't return capital to the limited partner, the value of the preferred return that the LP is entitled to increases. Now, on the one hand, if we're talking to LPs, that makes a lot of sense, right? That money's with the GP. We're in a closed-ended capital structure. Any day that you don't give me that capital back, I need to be compensated for. The downside from the general partner perspective of a time-weighted rate of return as a preferred return calculation is that it does not, in every instance, allow them to extract the maximum amount of value from their portfolio companies that they otherwise would be able to, especially right now where we're talking about an environment with rising interest rates where it's very difficult for these fund managers to exit in a timely manner. So you find a lot of GPs needing to make a very, very difficult decision. And that decision is, do I hold on to a portfolio company for another year? Because I think I'm going to be able to extract X amount of value out of that additional year of work, right? Out of that additional time period that I'm holding that portco. is that going to be completely eaten into by the preferred return that we need to give to the limited partner? And it puts GPs in a very, very difficult position where they're often forced to liquidate prior than they otherwise would choose to, because they don't want those gains to be eaten completely into by pref. So a nice middle ground would be to structure preferred return not as a time-weighted rate of return, but as something like a multiplier on contributed capital. And that's going to be a static value. That's going to say we are going to give you X amount of dollars. Once you distribute back to us proceeds in excess of, say, 2.53, 3.5%, the GP will be eligible for carried interest. That takes some of that time pressure off of the GP, allowing them to extract maximum value out of their portfolio companies, while at the same time ensuring the limited partners a significant rate of return. Operationally, that also helps you with your cast forecasting models, right? A 2.5x on capital is always going to be a 2.5x on capital. That's a set number. You know what that number is going to be. You know the dollars that you're going to get before you start paying carry. So it has that benefit as well. So those are sort of structural arrangements within an American-style waterfall that will be codified into a limited partnership agreement or into a specific side letter that structurally hedge against the risk of clawback. Now, there are also several practical things that we really advise limited partners to engage in order to hedge this risk. The most significant of which is ask for access to your general partner's downside scenario models. Every GP in this environment at the time of a distribution and at quarter end are running very, very detailed downside scenario models. We know that's true because we at Citco are assisting with those calculations. It's just part of best practice at all of these fund managers. And what those models will do is a couple of different things, right? One, they'll run through the value of the current unrealized portfolio. They'll also run downside scenarios saying, if all of my unrealized deals were to go to zero today, what clawback would I be entitled to? What carry would I be entitled to, and what is my associated clawback? Now, those are just models, right? Those don't dictate how much carry the general partner is actually taking. So what we always recommend is just ask for access to those models so you can see what your clawback risk is and work with your general partners at the time of a distribution to say, okay, are we actually going to take this carry? Because my downside model is saying this, right? My downside model is saying that if I do take this carry, 15% of that could be subject to clawback. Because look, it's not a situation that we want to be in. As you know, if you do find yourself in a clawback situation, there's litigation involved, and you're never going to be able to claw back 100% of that overage that you've taken, because clawback calculations are post-tax concepts, right? If you've taken in excess, let's say you've taken $100 in excess carry that you're not entitled to, the only amount that the LP is going to be able to claw back are the post-tax value of those dollars. So it's really not a situation that we want to be in. And so we really recommend that the LPs take a much more detailed look at the decision-making with the general partners when they're determining what carried interest, if any, they want to take. And we also recommend that limited partners explore the option of fee verification, meaning at the time that you're contributing capital to a general partner, a side letter provision or a provision of your commitment into that GP will be a requirement that the carried interest that the general partner is calculating is verified by a third party. That could be a fund administrator. That could be just a separate audit firm. We're seeing more and more of that. And what that really does is ensures a couple of things. One, it ensures that there's transparency in how carried interest is being calculated and how these decisions are being made. And it also ensures that carried interest is being calculated in accordance with your limited partnership agreements. as a component of our fee verification offering, anecdotally, we see about an 85% error rate in the way that carried interest is being calculated for funds with complex American-style waterfalls. The reason for that, at least in our experience, has never been nefarious. It's never been a general partner trying to do something creative. It's simply a misunderstanding of how the provisions of the LPA read. It's a misunderstanding of what data points need to be included in that calculation. It's the fact that a lot of these calculations are being done offline in Excel spreadsheets, and an old LPA that has an associated model may not be applicable for a new LPA, even though it's just been kind of passed down from accountant to an accountant. So the option of employing a fee verification agent is something that we strongly recommend as well.
Where do you find a fee verification agent? Are they, you employ them yourself? They work for Citco, or they're?
We recommend third party. So of course at Citco we have that offering. I'm not here to try to sell Citco's fee verification.
What kind of third parties? Can you just name a few?
Callmore has a strong offering. They're a consulting firm. Okay. There are a lot of consulting firms and audit firms. KPMG has a strong offering. Ernst & Young has a strong offering. Okay. Yep. Any other questions there on waterfall calculations, clawback, anything along those lines? Sure. Yep. Yep. When you're on the GP side of the lender, you get pushed back there, takes the rate return. That also. Well, on the GP side, what the, like if you use an MOIC, some kind of multiple on contributed capital as your preferred return, it takes the time pressure off of them, right? Because a 2.5x is always going to be a 2.5x, whether they sell today or they sell tomorrow. Where we see pushback on the GP side is that the LPs, if they're going to go away from a time-weighted weight of return, they want a significant multiple, right? They want to ensure that we're going to get a significant dollar value. So there's negotiation, right? But usually what we see is that a time-weighted weight of return is something slightly higher than what an 8% IRR would equal to were you to sell on the same day. Yeah. Sure. Any other questions?
I was just wondering, what's the impact of, if you're like a private equity fund with co-investors, and if they impact that calculation at all when you bring in a larger pool of co-investors, or you have to make sure that they're not included in the calculation too, right? I mean, if you're doing a weighted average, you want to make sure the co-investor pool isn't included in that. Is that correct?
So we would say never do that. We always recommend that waterfall calculations be performed on an individual limited partner by limited partner basis.
Right.
Yeah. So whether you come in through a co-invest or whether you come in through the fund, the calculations are done at the individual LP level.
And what about things like liquid private equity and things like that, which are making it more harder to make that calculation?
It's really tricky. It's really tricky. When you have a closed-ended capital structure that's employing kind of like a hedge fund style trading structure, yes. When you have volume, when you have current income, waterfall calculations are capital structures. They're based on capital contributions, capital distributions. In a typical private equity fund, you're kind of calling for deals. You know what that money is being used for. In a hybrid fund or a fund that has liquid investments, you have no idea. Cash is fungible. What becomes extremely important there is you ensure that your general partners have a very accurate way of allocating uses of capital to the source of that capital to ensure that your preferred return is being calculated correctly. I will say that hybrid structure, it's the biggest challenge that we're seeing when it comes to accurately calculating carried interest.
And there's a few of those that have come out more recently, the liquid private equity structures.
And that's where the market's going.
And just to clarify, so liquid private equity, we have a private equity fund, but they're hedging their bets in the public markets.
Exactly.
So, yeah, fascinating. Any other questions?